Internal audit signals control. At Canoo, an internal audit officer traded before disclosure. Jai Sondhi was Canoo's Senior Director of Internal Audit and Controls. In internal meetings, he learned about a confidential deal with a prominent retailer, then bought stock. The stock jumped more than 50% the day the deal became public. A federal court permanently barred Sondhi from further securities violations. He can seek to return to SEC accounting practice after 3 years if the commission agrees. Canoo built electric vehicles, commercial fleet vans, delivery trucks. It traded publicly, listed on the NASDAQ, registered with the SEC under Section 12(b) of the Exchange Act. That status creates continuous disclosure obligations. There's a boundary between what a company knows internally and what it tells the market, and internal audit exists to protect that boundary. Sondhi was the person holding it, a licensed CPA in Texas. He held the internal audit and controls role at Canoo for exactly 10 months, February through December 2022. That window included the trades that would end his ability to practice before the SEC, and it started with one meeting he wasn't supposed to profit from. In June 2022, Sondhi attended internal meetings, not shareholder calls, not public disclosures. What came up? Canoo was in the final stages of a transaction with a prominent retailer for a large order of commercial electric vehicles. Confidential, material. The SEC's order is specific about what access like that creates, a duty of trust and confidence owed to Canoo and its shareholders. Not a suggestion, a legal duty, and according to the commission, Sondhi breached it. So he traded, late June, early July 2022, while he still had that information and the public didn't. Sondhi bought Canoo common stock and call options, which expire worthless if a stock doesn't move fast enough within a set window. Buying them isn't hedging, it's a bet that something specific is about to happen and happen soon. July 12, 2022. Canoo announced the deal. Stock jumped 53% that day. Sondhi held stock and options he'd bought weeks earlier, and according to the SEC's complaint, he bought them despite knowing that Canoo's own company policy prohibited him from doing so. $54,965. That's the gain the SEC attributes to him, part realized when he sold, part still unrealized in the options he held. Not a fortune, enough, according to the commission, to justify a federal securities case. This isn't the first time this same underlying pattern has surfaced. In 2013, the SEC charged the former partner in charge of KPMG's Pacific Southwest audit practice, the person leading audits for that firm's biggest clients, with tipping a friend to confidential information about 5 of those client companies. The two men had met years earlier at a country club and become close friends and golf partners. On those tips, the friend made more than $1.2 million trading ahead of earnings and merger announcements before both men were caught. Different firm, different decade, different social context. Same structural problem. The person whose job is verifying what's true is also the person with the earliest access to what isn't public yet. One legal analysis of recent SEC enforcement activity has characterized the Commission's priorities as targeting gatekeepers specifically: auditors, compliance officers, anyone positioned to see problems before investors do. When that access gets used for personal trading instead of institutional protection, it's not treated as an ordinary trading violation. It's treated as the gatekeeper function failing from the inside. One detail from Sondhi's own complaint sharpens the KPMG comparison rather than softening it. Scott London tipped a friend. He didn't trade himself. Sondhi traded directly on his own account, despite a written company policy telling him not to. That's not a gap in judgment about an unwritten expectation. It's a documented decision to act against a rule he already knew existed. On April 28, 2026, nearly 4 years after the trades, a federal court in the Northern District of Texas entered final judgment against Sandy by consent. Consent judgments carry no admission and no denial of the underlying allegations. Sandy agreed to the terms without a trial. 2 separate consequences followed, and they're structurally different kinds of permanent. The court's injunction permanently bars Sandy from future securities law violations. That's a judicial order. It doesn't carry a review process or an expiration date. The SEC's own action is different by design. Under Rule 102E of the Commission's own procedural rules, a court injunction against an accountant gives the Commission grounds to suspend that person from appearing or practicing before it, not automatically, but at the Commission's discretion, with due regard to the public interest. That's what happened here. Not a second punishment layered onto the first, but a separate proceeding the Commission chose to bring because the injunction gave it the legal basis to. Sandy's suspension from practicing before the Commission comes with a defined path back. After 3 years, he can apply for reinstatement, submitting sworn statements, confirming no further violations, disclosing his full professional history since the suspension began, including every job and every client, if he wants to prepare financial statements for public companies again. An independent audit committee has to agree to review his work. If he wants to work as an outside auditor, his firm has to be registered with the Accounting Oversight Board and clear of disqualifying quality control findings. The Commission can investigate any of it before deciding, and the burden runs the other way. From what people assume, it's on Sandy to prove reinstatement is warranted, not on the SEC to prove it isn't. The rule itself is specific about what makes this kind of proceeding possible. Rule 102(e)(3)(I) allows the Commission to suspend any accountant who has been by name permanently enjoined by any court of competent jurisdiction by reason of his or her misconduct in an action brought by the Commission. The injunction is the legal basis for the suspension, not proof that one automatically follows the other. The Commission still had to decide in this specific case that suspension was appropriate. That's why Sandy faced 2 separate actions from 2 separate authorities for what was, at its core, one set of trades, one mandatory outcome of the settlement, one discretionary decision that followed it. Even after 3 years, the attestations required go beyond simply staying out of trouble. Sandy would have to swear, under penalty of perjury, that he hasn't been charged with a felony or a crime involving moral turpitude since the order, that no court or agency has found him in violation of federal securities law beyond what's already in this record, and that he isn't currently the subject of any pending SEC or PCAOB investigation tied to the same conduct. Any one of those conditions failing keeps the door closed, regardless of how much time has passed. The SEC's own complaint credits the Financial Industry Regulatory Authority with assisting the investigation. The record doesn't say whether Canoo's own systems ever flagged the trades, only that FINRA helped build the case the SEC ultimately brought. Added up, $54,965 in disgorgement, giving back exactly what he made, $15,969 in prejudgment interest, a civil penalty matching the original gain, dollar for dollar, $125,899 total, more than double what the original trades earned him. Here's what the SEC's public record doesn't say: whether Sandy was the only person in that room with access to the information he traded on. It doesn't have to say it. That's not what this case establishes, but it's worth sitting with. Internal controls exist to catch exactly this kind of exploitation, a title that says, "I watch for problems." What this case shows, and what the KPMG case showed over a decade earlier, is that the title itself proves nothing. Access is access. Whoever holds it, regardless of the letters after their name or the office they sit in. If your organization has a room where confidential numbers get discussed, the real question isn't whether the person with the audit title can be trusted. It's who else has walked into that room, and whether anyone's checking. That's the same question this channel has raised before, when a platform's own verification systems became the thing fraud moved through instead of the thing that stopped it. The names change. The mechanism doesn't. Whoever sits closest to the truth before it becomes public is also whoever's best positioned to profit from it privately. And whether anyone's actually watching that person the way they're supposed to watch everyone else is a real part of what stands between those two facts. Sondi's case ended with a signature on a consent judgment, a 6-figure repayment, and a suspension he can spend the next 3 years trying to lift. None of that required proving he was uniquely dangerous or that his employer's controls were uniquely weak. It required proving one thing, that he had access and that he used it. Any organization with a confidential information room likely has a version of that same exposure sitting somewhere inside it. The open question is whether anyone's checking for it before the SEC has to.